So imagine a business that grows its revenue by over 50%. I mean, in a single year.
Right.
It triples its assets to this staggering 17 billion rupees. And its operating profit margins are sitting pretty, north of 45%.
Which is massive.
Yeah, exactly. If you're looking at that balance sheet, you'd probably just buy that stock instantly, right?
Oh, absolutely. On paper, it looks incredible.
But what if I told you that exact same company, despite all of that top-line glory, is somehow burning cash?
Yeah, that's where the story gets wild.
Right. What if I told you its boardroom is virtually a ghost town when it comes to institutional oversight? And get this, it just valued a subsidiary at 5,550 times its original worth in just 8 months.
It is the ultimate paradox in modern corporate growth, to be honest.
Welcome to the deep dive. Today, we are completely deconstructing EFCI Limited, or EFCIL.
Yeah, and this is a fascinating one for you guys listening because you have this genuinely brilliant, highly defensible operational strategy, but it's sitting in the exact same room as some of the most terrifying governance and capital allocation red flags you will ever see.
Exactly. We are going to tear down their incredibly unique real estate as a service business model, trace the actual cash flowing through their financial engine, and then weigh this massive growth potential against, well, those dark internal realities.
It really is a masterclass in how top-line numbers can completely blind you to structural rot.
It is. And that tension is exactly what makes this specific analysis so crucial for anyone evaluating businesses.
Right, because we always want the narrative to be simple, binary. A company is either a visionary unicorn or a hollow house of cards.
Yeah, but EFCIL refuses to be neatly categorized like that.
Exactly. Their unit economics are formidable. But, as we're going to see, building a brilliant machine does not necessarily mean the people pulling the levers are aligning their interests with the minority shareholders.
Right. So let's get straight into the machine itself, because EFCIL is not, they're not your standard commercial landlord.
Not all.
They operate this integrated workspace solutions model. And to understand how they actually capture revenue, we kind of have to break down their 3 core verticals.
Right, the 3 pillars of the business.
Exactly. So vertical number 1 is the anchor. Real estate leasing and managed office spaces. This is driving roughly 55 to 64% of their total revenue.
The lion's share.
Yeah. We are looking at 57 centers spread across 7 major Indian cities, managing over 3.23 million square feet and more than 68,000 seats.
And just to put that 3.23 million square feet into perspective for you,
Yeah.
that is the equivalent of operating several of the largest shopping malls in the world, entirely dedicated to enterprise office space.
Oh, wow. Yeah, that really puts the scale in perspective.
Right. This scale automatically filters them out of that boutique co-working category. They're operating in a very specific, heavy-hitting weight class. But the defining characteristic here isn't just the sheer square footage. It's how they actually architect the ownership of that space.
Because they run a pure OpCo-PropCo model.
Exactly. They rigidly separate the operation side from the property ownership.
Yeah. When you map out their actual physical portfolio, they only own about 9% of it. The remaining 91% is leased.
Which is a huge strategic choice. Fundamentally, they're shifting their risk profile.
Right. They avoid the catastrophic capital expenditure of actually buying real estate in Tier 1 Indian cities.
Yeah, which keeps their asset base relatively light and allows them to expand rapidly. But, it introduces massive lease liabilities.
It's a trade-off.
That is the exact trade-off. If you try to buy 3.23 million square feet of prime commercial real estate in Mumbai, Pune, or Bengaluru, your return on capital employed will absolutely crater.
Because the upfront cash requirement is just astronomical.
Exactly. So by leasing 91% of their portfolio, they're playing a purely operational game. They're optimizing for capital efficiency.
They lease the raw space, apply their proprietary overlay, and then monetize the margin between their master lease and the individual seat rentals.
Right. And that brings us to where the strategy gets highly differentiated. Vertical number 2.
The design and build services.
Yes, the D&B division. This contributes about 38 to 39% of their revenue.
So they're not just managing the space, they are executing massive turnkey interior fit-outs.
For major IT, banking, financial services, and e-commerce clients, they have the capacity to swallow single contracts valued up to 200 crore rupees.
200 crore, that's what, like 24 million US dollars on a single interior fit-out?
Yeah, it's an incredibly complex logistical operation, We are talking about concept design, space planning, general contracting, project management, and the entire MEP stack.
MEP being mechanical, electrical, and plumbing, right?
Exactly. For a traditional co-working operator to handle a client request of that magnitude, they have to act as a middleman. They have to farm out the architecture, the contracting, the procurement to third parties.
Which naturally leads us right into vertical number 3, furniture manufacturing and sales.
The final piece of the puzzle.
Yeah, it sits at about 5% of their revenue currently, but they are running a massive 1.25 lakh square foot manufacturing facility in Pune. They've even launched their own premium brand, Mirova.
It's an interesting addition to the model.
It is. When I was putting all 3 of these verticals together, the clearest analogy that came to mind was that EFCIL has essentially built a full-stack restaurant for corporate real estate.
Oh, I like that. I think that captures the operational density perfectly.
Right. Think about it. If you want to open a massive corporate headquarters, normally you have to rent the concrete shell from a landlord.
Right. Step 1.
Then you go hire an independent architect to design the floor plan. Then a separate general contractor to build out the server rooms and cafeterias, and then a totally different commercial supplier to sell you the ergonomic chairs and workstations.
Which is a logistical nightmare for the client.
Exactly. But what EFCL is doing is stepping in and saying, hey, we hold the master lease for this space, but we also employ the architects who design the layout. We run the construction crews who build the walls, and we literally own the factory in Pune that manufactures the desks you will sit at.
It is an ecosystem meticulously engineered to capture every single dollar of capital expenditure that a corporate client assigns to their physical footprint.
Every dollar.
And when you look at the friction involved in commercial real estate, you instantly see the competitive moat this creates against pure-play operators.
Like who?
Take companies in the Indian market like Office or SmartWorks. Their fundamental business is spatial arbitrage. They rent a floor, chop it up, and rent out the desks.
Right, the traditional co-working model.
But when a global banking client comes to them and demands a custom, highly secure, branded environment for 500 engineers, the pure-play operator is immediately at a disadvantage.
Because they have to stack margins, don't they?
Exactly. They have to pay a markup to the external architect, a markup to the contractor, and a markup to the furniture supplier, all while trying to maintain their own profit margin on the master lease.
Not to mention the supply chain nightmares and project delays when 3 different external vendors are all trying to coordinate on the exact same floor.
Yeah, that coordination friction is the silent killer in commercial fit-outs. By vertically integrating the entire stack, EFCIL strips out those middleman margins and controls the timeline entirely.
And the proof that this ecosystem actually resonates with enterprise clients is written all over their operating metrics. I mean, in the first quarter of FY26, their managed office vertical hit over 90% occupancy.
Which is wild. In the commercial real estate sector, especially post-pandemic, maintaining over 90% occupancy across millions of square feet is an incredible feat of sales and retention.
It really is a phenomenal number.
But the metric that truly validates the full-stack model is their churn rate. It hovers around a remarkably low 4 to 5%.
4 to 5%, that's nothing.
Right. Because when a massive enterprise client allows EFCIL to design the space, build the space, supply the bespoke furniture, and manage the daily operations, that client becomes deeply embedded.
The switching costs become massive.
Exactly. Moving 1,000 employees out of a custom-built, fully managed headquarters to start the entire design and build process over again from scratch with another vendor, it's a logistical nightmare most CFOs will gladly avoid.
So the high-friction lock-in works beautifully. They've built this interconnected machine.
Yes, they have.
But, and this is a big but, creating that lock-in requires immense upfront capital. Building out a 200 crore bespoke office requires EFCIL to front cash for raw materials, factory runs, and construction labor long before the client settles the final invoice.
And that creates a severe tension between the high margins they're chasing and the cash burn required to secure them.
Right, which perfectly explains the fascinating and honestly somewhat paradoxical unit economics keeping this whole operation afloat.
Yeah, to really understand their cash cycle, we have to look at the per-unit economics of each vertical independently. Because under the hood, they behave like completely different businesses.
Let's start with the cash cow then. The leasing economics.
Right. Their average billing sits at about $80 to $85, which translates to roughly 6,600 rupees per seat per month.
And the crucial demographic detail here is that 80% of their clients are enterprise. They're not trying to herd a rotating cast of freelancers renting hot desks by the hour.
No, not at all. That enterprise concentration provides long-term revenue visibility, which is absolutely mandatory when you're dealing with the immense fixed costs of a lease portfolio.
Because in the managed office business, you have a baseline of expenses that do not care if your building is empty.
Exactly. You have the master lease payments to the property owner, the amortization of the massive upfront fit-out costs, and the baseline facility management payroll.
So there is this rigid break-even threshold they have to cross before a single rupee of profit is realized.
Spot on. For EFCIL's leasing segment, that magic number sits right at 70 to 80% occupancy. Up to that point, every rupee of that $85 per seat is just shoveling coal into the furnace to keep the lights on, and the landlord paid.
But the moment they sign a lease that pushes a center from, say, 80% to 81% occupancy, the financial physics completely change.
Oh, they changed dramatically. The operating leverage kicks in with brutal efficiency. Once a center clears that 70 to 80% hurdle, the incremental margins on every single additional seat rented skyrocketed. We are talking between 60 and 80%.
Wait, 60 to 80% incremental margin?
Yeah.
Because the rent for the building is already covered, the receptionist is already paid, and the HVAC is already running.
Exactly.
So if I rent that marginal seat for 6,600 rupees, almost 5,000 of those rupees drop straight down to the operating profit line.
That is the beauty of the model. Mature centers that sustain that 90+% occupancy are absolute geysers of high margin cash flow.
Okay, but this beautiful, recurring, high-margin reality sits in stark contrast to their design and build segment, which is a fundamentally different, far uglier financial beast.
Yeah, uglier is a good word for it. Looking at the D&B segment, the gross margins are significantly lower, compressing down to the 15 to 25% range.
But the real issue isn't just the margin percentage, right? It's the sheer working capital intensity driven by milestone billing.
Exactly. D&B is heavy industry. It is governed entirely by variable costs. You are buying structural steel, massive quantities of cement, commercial glass, and you are deploying specialized subcontractor labor.
There is very little operating leverage to be found here.
None. If you sign a second project, you have to buy a second set of steel and hire a second crew.
Let's trace a visceral example of how this burns cash for you listening. Imagine EFCL signs one of those massive 200-core fit-out contracts we talked about. Day one, they have to procure the raw materials. They are paying the steel suppliers, they're paying the plumbers, they are paying the electricians. Cash is leaving the bank account in massive waves. But because of milestone billing, the client isn't paying them back on day one.
No, the client says, we will release the first 50-core payment when the HVAC system is fully installed and certified. That might take 6 months.
That 6-month gap is the working capital trap. EFCIL has to finance that massive cash outflow internally or through debt while waiting for the milestone trigger.
And that aggressively consumes the cash generated by the leasing division.
Which immediately begs a massive strategic question. I mean, if D&B is a lower margin, highly cyclical, cash-burning construction headache of a business, why keep it?
It's a fair question.
If you were sitting on a leasing business that generates 60 to 80% incremental margins, why not just spin off the D&B division entirely, get rid of the working capital trap, and become a pure-play, high-margin leasing cash machine?
Well, if you were evaluating the D&B division on an isolated spreadsheet, spinning it off would be the obvious move. But you have to view it through the lens of enterprise acquisition cost.
What do you mean?
D&B is not designed to be a standalone margin generator. It is the hook.
It is the loss leader or the low-margin leader that guarantees the recurring revenue.
Exactly. Put yourself in the shoes of a massive multinational corporation looking to establish a footprint in Pune. You need a 5-year lease for 1,000 employees.
Okay.
You could go to a pure-play landlord and then spend the next 9 months dealing with independent contractors to build it out. Or you go to EFCIL, who says, sign a 5-year lease with us, and we will execute the entire 200-core fit-out in-house on our timeline with 0 external contractor friction.
Wow. So the D&B capability is the actual deciding factor that wins the massive enterprise contract in the first place.
It completely secures the tenant. And once that tenant is secured, EFCIL locks in 5 years of that high-margin recurring leasing revenue we talked about.
That makes total sense.
Furthermore, by bundling the D&B service with the lease and the furniture, they can obscure the individual line item costs and subtly increase the overall average revenue per user across the lifetime of the contract.
That makes the inclusion of the third vertical, the furniture manufacturing, make total sense too. It serves a dual purpose. They are targeting 300 crore rupees in standalone revenue by FY26 with EBITDA margins of 35 to 40%.
Which are exceptionally high margins for physical manufacturing.
Very high. And those margins are achievable precisely because of the captive audience. A factory requires massive fixed costs, machinery, warehouse space, base labor. But EFCIL's factory in Pune has guaranteed demand because they're supplying their own 3.23 million square foot managed office portfolio.
Exactly. They are their own biggest customer.
They eliminate their own procurement costs while simultaneously scaling the factory volume enough to achieve the operating leverage needed to hit those 40% margins. And now they're using that scaled up capacity to expand into external B2B and B2C sales under that Morova brand.
It is a beautifully constructed internal supply chain. Every vertical feeds the other.
The factory supplies the D&B projects.
Right.
The D&B projects secure the enterprise tenants.
Yep.
And the enterprise tenants fill the managed office space, generating the high margin cash flow to fund the next round of factory expansion and D&B procurement.
It's an elegant loop. So mechanically, the per seat, per project ecosystem is incredibly sound.
Right. But an airtight business model doesn't automatically translate to 50% year-over-year revenue growth. I mean, to understand the sheer velocity of their top line, you have to look outside the company and look at the terrifying scale of the Indian commercial real estate market.
Oh, absolutely. The total addressable market, or TAM, in this space is almost difficult to fully conceptualize because of the sheer density of the urbanization happening in India right now.
Let's look at the baseline numbers for a second. The overall office leasing market in India is estimated to be between 1.5 and 2 lakh crore rupees annually.
That is roughly 18 to 24 billion US dollars just for the leasing.
Just the leasing. Then you add the commercial fit-out market, the sandbox for their D&B segment, which represents another 40,000 to 60,000 crore rupees of annual spend.
It is a vast ocean of corporate capital expenditure. And the most compelling data point in this entire macro analysis is EFCIL's current market share.
Oh yeah, this blew my mind.
Despite operating over 3 million square feet, they currently serve a microscopic 0.1 to 0.2% of this TAM.
Wait, 0.1%?
Yes. They are managing roughly 68,000 seats in a market capable of absorbing millions upon millions.
Which means the ceiling is effectively non-existent for the foreseeable future.
Exactly.
And they're not just relying on organic market growth. There are massive structural tailwinds aggressively pushing demand toward their specific integrated model. You have raw urbanization, with 5 to 7 million square feet of new office space being added annually in Tier 1 and Tier 2 cities alone.
And you have a massive push for formalization. Historically, up to 60% of this commercial real estate market has been highly fragmented and unorganized.
But regulatory shifts, particularly frameworks like RERA, are forcing transparency and compliance.
Right, which is driving enterprise clients away from informal landlords and straight into the arms of organized institutional-grade operators like EFCIL.
And on top of that, you have the profound, permanent shift in corporate behavior post-pandemic. The era of a corporation signing a rigid 10-year lease for a concrete shell and spending a fortune to build it out, it's dying.
It's completely dead. Hybrid work and digital adoption demand agility. Flexible and managed workspaces now account for 20 to 25% of all new commercial leases.
Companies want the ability to scale their footprint up or down rapidly without taking massive write-downs on custom office furniture and server rooms.
Which is the exact agility EFCIL is selling. When you combine an $18 billion TAM, massive urbanization, the death of the unorganized sector, and the permanent shift to hybrid workspaces, you get the kind of top-line explosion EFCIL is currently reporting.
The numbers definitely validate this thesis completely. In Q3 of FY26, their revenue hit 2,695.9 million rupees, delivering that 52% year-over-year growth. And looking back at Q1 FY26, their net profits surged 196% to 36.7 crore rupees.
It's staggering growth.
It makes me think of an analogy. EFCIL is like a surfer who has spent years hand-shaping a perfectly engineered, highly technical surfboard, which is their integrated OpCo-PropCo, D&B, and manufacturing ecosystem.
Okay, I'm with you.
Right now, they are surfing in a relatively calm, small inlet, capturing their tiny 0.1% market share. But just offshore, there's an absolute tsunami of a market, that 2 lakh crore TAM, that is just beginning to break toward the shore. The runway for them to ride this wave is almost absurdly long.
The visual is apt, but the mechanics of catching that tsunami are incredibly dangerous. You can have a perfect surfboard, but if you don't have the physical stamina to paddle into the wave, it will just crush you.
What do you mean?
Well, the structural tailwinds are doing the heavy lifting to create the demand, sure. But for EFCIL to scale their market share from 0.1% to even a single percent of that TAM, the execution dependency is monolithic.
Because capturing that demand requires massive upfront capital expenditure.
Exactly. You don't just magically absorb another million square feet of market share. You have to go out and sign master leases on prime real estate. You have to fund the initial interior fit-outs. You have to manufacture tens of thousands of new desks.
Right.
And most dangerously, you have to endure the agonizing ramp-up periods where a newly opened center is sitting at 30% occupancy, aggressively burning cash, while you wait for the enterprise sales team to secure the tenants required to cross that 70% break-even threshold.
Ah, I see. So the challenge isn't finding the demand. The challenge is financing the capacity to meet the demand without obliterating their balance sheet or diluting their operating margins through over-leverage.
Precisely. That's the real test.
So if we pause here and look at the narrative we've constructed so far, we have an almost utopian investment thesis. A massive total addressable market, highly profitable unit economics at maturity, profound structural tailwinds, and a vertically integrated ecosystem that locks in enterprise clients. Normally, this equation equals a perfect, untouchable growth story.
It is the exact profile that makes growth investors salivate.
But, and this is a monumental but,
Here we go.
the moment you stop looking at the macroeconomic plan and the top-line revenue growth and you pivot to look deeply into EFCIL's balance sheet, and more importantly, the power dynamics inside their boardroom, the utopian narrative shatters. A completely different, deeply troubling reality emerges.
This is the crucial pivot in our analysis. We are shifting from their operational brilliance on the ground to their governance and financial realities in the boardroom. And the most glaring red flag begins with a fundamental disconnect in their cash flow statement.
Let's trace the numbers carefully. We established earlier that they are reporting an incredibly robust 45.46% operating profit margin. We know their asset base has ballooned to 17 billion rupees. The business is demonstrably scaling. But despite all of that reported profitability and massive asset expansion, their operating cash flow is negative.
Which is the single most jarring paradox you can find on a financial statement.
Right. High operating margins coupled with negative cash flow should trigger immediate aggressive skepticism.
It means the profitability you are seeing on the income statement is an accounting reality, but it is not a cash reality.
So they are recognizing the revenue. The spreadsheet says they made a profit, but the actual physical rupees are not arriving in the bank account.
Exactly. It suggests severe working capital mismanagement. Now, we discussed the milestone billing in the D&B segment, which certainly consumes cash.
Sure.
But when you have mature leasing centers supposedly throwing off 60 to 80% incremental margins, that should be enough to subsidize the D&B working capital.
You would think so.
The fact that the aggregate cash flow remains negative implies that either their receivables are piling up, meaning clients simply aren't paying them, or they are burning cash so aggressively on expansion that the core business cannot sustain the growth internally.
Or there's a third option. Capital is bleeding out through incredibly opaque corporate structuring. And that brings us to the most shocking detail in this entire analysis. The merger involving their subsidiary, White Hills Interior Limited, or EFCIL.
Yeah, this specific transaction is the epicenter of the governance concerns.
Let's look at the timeline. EFCIL executed a merger with this subsidiary. In the span of just 8 months, the valuation of White Hills Interior Limited skyrocketed from 10 lakh rupees to an astonishing 545 crore rupees.
For anyone doing the mental math on that, that is a 5,550 times increase in valuation in under a year.
I mean, how does a paper valuation jump of that magnitude mechanically happen without the underlying business discovering a literal gold mine under their headquarters?
It's highly suspicious.
The proxy advisory firm, SES, flagged this exact transaction, explicitly noting it as potential SEBI fraud. And when you look at Wheeler's actual performance, the valuation becomes even more absurd. They projected 41 crore in net profit. They delivered 13 crore. They missed their own internal projections by 67%.
And that's not even the worst part.
No. The most terrifying line item. Will operates with 100% overdue receivables.
We need to linger on the sheer absurdity of that metric for a second. 100% overdue receivables means that literally every single rupee that White Hills Interior Limited has billed to its clients has failed to be collected on time. Not a single invoice was paid according to terms.
If your clients refuse to pay you, your business is effectively a charity.
Or it is a vehicle for something else entirely. When a proxy advisor like SES flags a 5,500 times valuation jump sitting right next to 100% overdue receivables, they're essentially screaming that the revenue being reported might not be real. They are questioning whether these are actual arm's-length transactions with independent clients, or if revenue is being artificially inflated through circular related party dealings just to pump up the paper valuation of the subsidiary.
And the filings explicitly point to related party loans amounting to 255 crore rupees.
There's the mechanism. If you are shuffling 255 crore rupees of loans back and forth between the parent company and the subsidiary, you can manufacture a massive paper valuation.
I see.
You can issue shares against those loans, inflate the equity base, and make the subsidiary look like a 545 crore juggernaut. But because it is just related parties moving IOUs around, no actual external cash ever enters the system.
Which perfectly closes the loop on our initial paradox. This is exactly why the parent company has negative cash flow despite reporting 45% margins. The wealth is entirely theoretical. The balance sheet is inflating on paper, but the bank accounts are draining in reality.
And inflating your balance sheet on paper has very real-world consequences when it comes to leverage. Let's look at their debt position.
Right. The debt-to-equity ratio was reported around 0.43, and though the FY25 reporting showed some structural shifting, bringing it up to 1.32%, the absolute nominal debt figure is what actually matters here. 3 billion rupees.
3 billion rupees in debt requires consistent, heavy cash flow just to service the interest payments, let alone pay down the principal.
And their operating cash flow coverage of that massive debt pile is an incredibly thin 11.8%.
Which leaves them with virtually zero margin for operational error. When your operating cash flow only covers 11.8% of your debt, you're dancing on a razor's edge.
Yeah.
If the macroeconomic environment shifts, if occupancy drops even slightly, or if major clients begin delaying payments, which we know for a fact is already happening catastrophically inside their Will subsidiary servicing, that 3 billion rupee debt ceases to be an accounting exercise and becomes an immediate existential liquidity crisis.
So we have a company with massive debt, negative cash flow, and highly questionable subsidiary valuations. This brings us to the inevitable question: who is actually steering this ship, and why is no one in the boardroom pulling the emergency brake? Let's look at the management structure, specifically focusing on the CEO, Umesh Sahay.
The boardroom dynamics here are a textbook study in agency risk.
The ownership structure is highly concentrated. Sahay holds a massive personal stake, reported between 23% and 39%. And his compensation structure is utterly fascinating. He takes a flat 9 million rupee salary, and he receives absolutely 0% in performance bonuses. Now, I have to push back hard on the idea that this is inherently negative. If you look at some of the most successful companies in the world, Meta, with Mark Zuckerberg, or Amazon in the Jeff Bezos era, they were defined by massive, concentrated founder ownership. As a potential investor, shouldn't I be thrilled that the CEO owns almost 40% of the equity? His personal net worth is inextricably linked to the stock price. That is the ultimate definition of skin in the game. Why is concentrated ownership suddenly a severe governance risk here?
It is a phenomenal question, and you are right that skin in the game is the gold standard for aligning incentives. But the Zuckerberg or Bezos comparisons fail here because of the lack of institutional counterweight.
What do you mean by institutional counterweight?
When founder ownership scales to nearly 40% and another non-executive director holds 20%, you cross a very dangerous line. You transition from alignment to absolute entrenchment.
Because the insiders control a completely unassailable voting bloc.
Exactly. And let's look at who is providing the oversight. Institutional ownership in EFCIL, the mutual funds, the pension funds, the entities that usually demand rigorous governance and independent audits, is a paltry 8.52%.
Wow. So the serious institutional money has looked at the board, looked at the cash flow, and decided to stay far away.
Which means the CEO was operating in a vacuum. There is no major institutional shareholder capable of forcing transparency or demanding an explanation for a 5,550 times subsidiary valuation jump. He has absolute unchecked control. Now, combine that unchecked power with his specific compensation structure.
The flat 9 million rupee salary with zero bonus.
Right. On the surface, a flat salary seems modest. But think about the mechanics of agency risk. Agency risk occurs when the daily financial reality of the executive is decoupled from the long-term health of the minority shareholder's capital.
Ah, I see where you're going with this.
Because he receives no performance bonus based on cash flow generation, return on equity, or debt reduction, his day-to-day compensation is completely insulated from operational failure. He gets paid his 9 million rupees regardless of whether the company generates free cash flow or burns it completely to the ground.
And if you look at the rest of the board, the people technically employed to oversee him, the power imbalance becomes almost comical. The independent directors, the exact individuals whose fiduciary duty is to protect the minority shareholders, are compensated between 560K and 610K rupees.
That is up to 16 times less than the executive compensation.
The sheer disparity in pay guarantees that the independent directors do not have the resources, the incentive, or the institutional backing to actually challenge the CEO's decisions.
It creates a perfectly insulated echo chamber. You have a CEO with absolute voting control, minimal institutional pushback, a fundamentally rubber-stamped board of independent directors, and a compensation structure that does not penalize him for burning cash. When a management team operates in a room that dark, decisions like inflating a subsidiary's valuation through related party loans can be executed without anyone having the power to ask why.
So we have a masterfully designed operational engine dropping straight into a chassis with massive structural rot. But even if we assume the absolute best, even if they magically reform the boardroom tomorrow, hire rigorous independent auditors, and fix their cash flow cycle, they still do not operate in a vacuum. They have to survive the macroeconomic environment. Which brings us to the final segment of our deep dive, the external threats, regulations, cyclicality, and raw input costs.
And the crucial context here is that because of the massive debt pile and the negative operating cash flow we just mapped out, EFCIL is uniquely, profoundly vulnerable to external macroeconomic shocks. They have zero shock absorbers left on the balance sheet.
Let's start with the regulatory sword hanging over their neck. We already mentioned the ongoing SEBI investigations regarding the Tamilaili merger. If the regulatory body determines that the valuation jump and the 100% overdue receivables constitute fraudulent reporting, the fallout wouldn't just be a fine. It could force them to unwind the entire transaction, instantly vaporizing a massive chunk of their reported asset base.
That is the catastrophic regulatory risk. But there is a much more mundane bureaucratic risk that could destroy their margins overnight. Local property taxes.
This goes back to the core of their OpCo-PropCo model.
Exactly.
Yeah.
Because they lease 91% of their portfolio, they do not own the buildings, but they are entirely dependent on the physical infrastructure of the cities they operate in. Municipal authorities in India regularly and aggressively reassess property taxes.
And those reassessments can be violent. Property taxes in major Indian commercial hubs can suddenly spike by 20 to 30% in a single year.
And under a typical commercial master lease, those property tax hikes are passed directly through to the lessee. EFCIL absorbs that cost.
Immediately. Now, consider their revenue model. They have locked their enterprise tenants into long-term fixed-price contracts to guarantee high occupancy.
Right.
If municipal taxes jump 30%, EFCIL cannot just walk into their client's office the next morning and demand a 30% rent increase. They are legally bound. So that tax hike eats directly and instantly into their 45% operating margin.
A sudden regulatory shift at the local municipal level could instantly drop those highly profitable centers right back down below the break-even threshold.
And that leads perfectly into the broader risk of cyclicality. The commercial real estate market is intrinsically tied to the macroeconomic cycle. It is a high beta industry. When the economy is booming, companies expand footprints. When a recession hits, the exact opposite happens.
Companies freeze headcount, they consolidate regional offices, they delay any plans for massive new headquarters, and worst of all, smaller tenants begin to default on their existing leases.
Let's run the math on a recession scenario for EFCIL. Remember the magic number we established for their leasing segment? The 70 to 80% occupancy required just to cover the massive fixed costs of the master leases and the facility management?
Yes, the threshold where the operating leverage flips from negative to wildly positive.
Operating leverage is a double-edged sword, and it cuts just as deeply on the way down. In a recessionary environment, if a major tenant defaults or if a few large contracts expire and aren't renewed, EFCIL's occupancy in a key center could easily drop from 90% down to 60%.
And the moment it drops to low 70, the math reverses violently.
Instantly, the rent owed to the underlying landlord doesn't decrease. The utility bills don't decrease. Suddenly, those heavy fixed costs are crushing them. The center flips from a cash cow into a massive liability, bleeding cash every single month. And remember what sits on top of all of this: 3 billion rupees of debt.
With an 11.8% cash flow coverage ratio.
Exactly. In a recession, a drop in occupancy doesn't just mean a bad quarter for earnings, it rapidly accelerates into an existential debt servicing crisis.
And it isn't just the leasing segment that suffers. The design and build segment is entirely exposed to input cost volatility. D&B relies heavily on physical commodities, structural steel, architectural glass, bulk cement.
Commodities that are highly sensitive to global supply chain shocks and inflation.
Right. If they sign a 200 crore fixed-price turnkey contract, and midway through the 6-month build-out, global steel prices spike by 20%, their already thin 15 to 20% gross margin is completely eradicated. They could easily end up paying for the privilege of building a client's office.
Which forces us to reevaluate the entire foundational premise of the company. Earlier, we praised their integrated full-stack restaurant ecosystem, the leasing, the design and build, the furniture manufacturing. We framed it as a brilliant, highly defensible, competitive moat.
We did. It solves massive friction for the corporate client.
But in a macroeconomic downturn, that exact integration becomes their greatest vulnerability. Vertical integration sounds incredibly safe because it mimics the concept of diversified revenue streams. You assume that if one division slows down, the others will compensate.
But in commercial real estate, those streams aren't diversified at all. They're perfectly, intimately correlated.
It is the ultimate domino effect.
Yeah. Trace the full-stack restaurant metaphor in a recession for a second. If a pandemic or a severe economic contraction hits, the corporate client doesn't just cancel their reservation at your restaurant. They stop eating entirely.
Precisely. The enterprise client decides to freeze expansion. They don't sign the master lease. Because they didn't sign the lease, they have zero need for the 200 crore interior fit-out from the D&B division. And because they aren't building an office, they absolutely do not need to buy 10,000 ergonomic desks from the furniture division.
The demand for all three verticals evaporates at the exact same millisecond. And because EFCIL owns the entire stack, they absorb the entire shock. They are left paying the master lease on an empty building, paying the payroll for idle construction crews, and paying the fixed costs of a massive manufacturing facility in Pune that has no internal orders to fulfill. When the cycle turns against a vertically integrated real estate operator, the entire ecosystem contracts simultaneously with devastating speed.
So bringing all of these incredibly potent opposing forces into a final synthesis, we are looking at a truly remarkable dichotomy with EFCIL.
We are. It is a study in extremes.
On one hand, you have a management team that has conceptualized and executed a highly innovative, deeply integrated real estate machine. They are tapping into a massive, formalized Indian market experiencing generational tailwinds. They are solving real, painful friction for enterprise clients, achieving over 90% occupancy, and executing with 50% plus year-over-year top-line growth. The operational engine is undeniably powerful.
But on the other hand, they are operating that machine within a boardroom dynamic that treats minority shareholders and institutional oversight as an absolute afterthought. They are severely burning cash, despite reporting incredible margins. They are carrying a heavy debt load with razor-thin coverage ratios. And they are executing deeply opaque, highly questionable subsidiary mergers that are triggering proxy advisor red flags and potential regulatory scrutiny.
It is the ultimate test for how you, as a listener and a learner, evaluate complex financial realities. How do you weigh brilliant, aggressive market strategy against fundamental structural governance rot?
Because in the real world, companies aren't just a spreadsheet of TAM and unit economics. They are living, breathing entities run by human beings with specific incentives, aggressive biases, and sometimes entirely unchecked power.
Exactly. The numbers only tell you what the machine is capable of doing. The governance tells you who the machine is actually working for. So I want to leave you with a final thought to mull over today. When you are evaluating any rapidly growing entity, whether it's a hypergrowth company like EFCIL, a revolutionary new technology, or an emerging market, you have to ask yourself a very specific foundational question.
What's the question?
If someone builds a genuinely brilliant, highly profitable, technically flawless machine, well, wait, let me rephrase that. If they build this amazing machine, but they insist on operating it in complete darkness behind closed doors with zero independent oversight and absolutely no financial accountability, are you actually investing in the machine? Or are you just placing a blind bet on the people holding the flashlight? Think about that the next time you see 50% growth numbers screaming across a headline. Until next time.